Continental Coffee.
Well, we've been talking about the way the Nifty Bank has come back in terms of an up move in just the last few months itself, has been the leading sector. Now we've got some upgrades as well. Credit Suisse has upgraded its earnings forecast for a bunch of large banks on the strength of higher margins and lower credit costs. Latha joins in with more on that. Latha, the street believes that things are fundamentally looking very good.
Well, Credit Suisse believes that it is a 6 to 15% earnings growth. That is their upgrade. And I'm saying Credit Suisse because the Credit Suisse financial sector expert, Ashish Gupta, is about the best in breed. Widely consulted by government and RBI. So it's very important that Ashish Gupta has given an upgrade of 6 to 15% for all the EPSs of the top banks. SBI gets the biggest upgrade, 15%, ICICI 13%, IndusInd and Bank of Baroda, would you believe that, 12% higher, and Kotak and Axis get a 6% upgrade, HDFC Bank gets a 3% upgrade. They say that this is, the Ashish Gupta report says this is EPS upgrade is on a mix of higher net interest margins as well as lower credit cost. Now, first, the net interest margin yields on all the loans are increasing because these loans are linked to external benchmarks like repo or T-bill. So, external benchmark linked loans are giving banks some 140 to 190 basis point increase in interest rates. And most of the loans they have given have also been retail. Before I come to the retail loans, in terms of deposit, the costs have not gone much. The retail deposits, which are maximum one-year deposits, they have gone up by only 40 basis points compared to the increase in the loan rates. Only the bulk deposit rates have gone up and they don't constitute a very big share for banks. Coming back to loan growth itself is strong at 15%. It's led largely by retail and SME. Within retail, it's unsecured. Now, what does all this mean? All these are high-yielding loans, unsecured loans. 30% of the retail loans are constituted by unsecured loans. As well, coming to credit costs, Gupta's report notes that private bank credit costs are lower by 50 to 70 basis points, even compared to their normal levels. Forget the last few years when, they were reeling under asset quality pressures. This is because corporate deleveraging has been very high and, the formula used, interest cover, whether it covers, EBITDA covers interest. The number of companies where EBITDA does not cover interest is at a historical low, which means corporate balance sheets have become robust. And that's why Credit Suisse has cut credit costs for banks by 5 to 20 basis points. The report ends with a very interesting addendum. Adani Group's debt alone has risen double. It has risen 2x in the last 2 years. In FY20, their total leverage was 1.36 lakh crore. In FY22, it is 2.6 lakh crore. But Indian Bank's exposure to Adani Group has not changed at all in the last 2 years. So a very, very interesting detail coming in.
Okay, Latha, thanks a lot for that. Well, let's do one thing. Let's wrap up with this edition of Halftime Report. Thanks a lot for watching. Business Lunch will take all the action ahead.